Hello, good evening.
Good evening, sir.
Good evening,
All
sir.
right.
Good evening, sir.
Yeah, thank you. Can we mute, please? Our class tonight we shall continue from where we stopped last week. Last week, we considered pricing theory. How to determine price of a product. We explained the importance of pricing. That how do companies determine selling price for their products? We explained that pricing is a very sensitive aspect of management responsibility. The selling price of a product determines the quantity demand, the selling price of a product will affect volume of sales and contribution. We explained that pricing can be used. You can use pricing to encourage competition or to discourage competition. Product pricing are influenced by several factors. There are several factors that determine company selling price. These factors include the company's corporate objective. One, we explained this last week. The corporate objective of a company will influence selling price. Also, the product cost will have impact on the selling price. The cost of production will influence the selling price of a product. Also, elasticity of demand will have impact on the product selling price. The degree of competition will impact on the selling price of a product. We discussed this last week. We also discussed method that can be used to set selling price. What are these methods? You can use full cost, cost plus pricing method, cost plus pricing method. Under it, we have full cost plus pricing method, whereby selling price of a product is determined by considering both the variable cost and the fixed cost. In addition to this, certain percentage markup will be added to the total cost so as to arrive at the selling price. Full cost pricing method. Consider all the costs: variable cost, fixed cost. In addition, a markup of certain percentage is added to the total cost. We discussed this last week. We also discussed marginal cost plus pricing. Under the marginal cost plus, selling price is determined by considering only the variable cost. Under the marginal cost plus pricing, selling price is estimated by considering only your variable cost. In addition to the variable cost, certain percentage markup is added to the total variable cost so as to arrive at the selling price. We discussed this last week. We also discussed target return pricing method. That is return on investment pricing. Under this method, the total cost of a product is estimated. Under this method, total cost of a product is estimated. In addition, target return on investment is added to the total cost. Target return on investment will be added to the total cost of the product so as to arrive at selling price. We discussed this last week. We also discussed pricing strategy. What is pricing strategy? When can we use pricing strategy? We explained that when a company is planning to introduce a new product to the market for the first time, me. Just 1 minute. When a company is planning to launch a new product for the first time, the company must decide on the appropriate pricing strategy to use for the new product. What is the appropriate pricing strategy we are going to use for this new product. We explained that there are two major pricing strategies that companies normally use. There are two major pricing strategies that companies normally use. What are these strategies? One is market scheming, pricing strategy. The strategy of charging higher price. When a product is launched to the market for the first time. Market scheming. You are charging higher price for a new product that is introduced to the market. The objective of market scheming is to gain higher profits at the early stage of the product life cycle. We discussed this. Market penetration, market strategy. Market penetration pricing, a strategy of charging low price for a new product that is introduced to the market for the first time. Market penetration pricing. You are charging low price when the product is newly introduced to the market. The objective is to penetrate the market. Alimo, please can you mute? You are charging a low price for your new product with an objective to penetrate that market. You want to capture the market. You want to obtain higher sales volume. You want to control the market. You want all the customers to come to your products. You are trying to penetrate with a low price so that you can achieve higher sales volume as quickly as possible. You can capture the market before competitors can introduce rival products. We discussed this last week. That was where we stopped last week. Any question, please? We have just done a review of our last lecture. Any question? All right. Tonight, we shall start with theoretical approach to pricing. We shall start with theoretical approach to pricing. What is theoretical approach to pricing? Economic approach to pricing. From microeconomic view, from the microeconomic viewpoint, a company should set a selling price that maximizes its profits. From theoretical viewpoints, from economic viewpoints, firms are expected to set selling prices that maximize their profits, because we are in business to make profits. Based on economic theory, companies are in business to maximize profit for the owners. Hence, companies should set a selling price. That selling price that will give the company the highest profits. That profit, that selling price that maximizes profit. The price is at the level of sales, where the marginal revenue equals marginal cost. The selling price that will maximize profits is that price at the level of sales, where your marginal revenue equals marginal cost. So the question is, what is marginal cost? What is marginal revenue? If I want to maximize profits, I must set a selling price at which my level of sales will equate marginal revenue with marginal cost. So the question is, what is marginal cost? What is marginal revenue? How can we calculate marginal cost? How can we calculate marginal revenue? Marginal cost is the additional cost incurred by the production of one extra unit. Your marginal cost is the summation of all variable costs. Your marginal cost is the addition of all variable costs. Marginal revenue. So we now know how to calculate marginal cost. Summation of all the variable costs. Marginal revenue. This is the additional revenue earned. Additional revenue achieved by selling one extra unit. Your marginal revenue can be described as the slope of the revenue function. What that means is, you can get your marginal revenue from your total revenue. Your marginal revenue can be derived from your total revenue. What happened? Amarachi, what happened?
And good evening, sir. So I need to understand that the number two, the price is at the level of sale. I'm here to understand that statement, please. I don't understand that part.
For you to maximize profits, your price must be at a level of sales where marginal revenue equals marginal cost. That's all. That's all. Just exercise patience. You know there is learning curve. Until we start putting question to some of these things. So you got to exercise patience. All right. Your demand function is also called your price function. You can also call it the demand curve. We also call it the price function. Your demand function explains relationship between selling price and quantity demanded. Your price function explains relationship between the selling price and quantity demanded. The higher the selling price, the lower the demand. The lower the selling price, the higher the demand. All things being equal. This is elementary knowledge of economics. If your selling price is high, the demand is likely to fall. If your selling price is low, the demand is likely to rise. Please note, there is inverse relationship between demand and price. Inverse. Now, why are we interested in the price function? Price function is a component of revenue. Your price function is a component of total revenue. Before you can get your marginal revenue, you must get your total revenue first. To calculate marginal revenue, you must get your total revenue first. Your marginal revenue can be derived or can be found by differentiating the expressions of total revenue function. Let me repeat that point. Marginal revenue can be derived by differentiating differential calculus, differentiating the expression for total revenue with respect to quantity. Here we are going to require the knowledge of differential calculus. All right. Let me introduce a small table to help our explanation. So if you are trying to maximize how do I put this? If you are trying to get a selling price that maximizes company's profits, then you are going to equate marginal revenue to marginal cost. If you are trying to calculate that selling price that will maximize company's profits, it is the price at a level of sales where marginal revenue equals marginal cost. Getting your marginal cost might not be difficult. We simply add all the variable costs. But how do you get your marginal revenue? How do we get the marginal revenue out? Now look at the process. First, you start with the price function. Price function. Or you call it price equation. Your price equation is giving us P is equal to A plus BQ. You can write it down if you like. The price equation or the price function is also called the demand function. P is equal to A plus BQ, where your P is the current selling price. Your small letter A is equal to price at which demand is 0. That selling price at which nobody will buy the product. Oh. Your B, it comes with minus change in price over change in quantity. There's a negative sign here. The higher the price, the lower the demand. That negative represents inverse relationship. Yes. Please just hold on. Please 1 minute. Let's continue with the class. Your letter T. Quantity demanded. So price is a function of autonomous price, change in price and quantity demanded. This is your price function. You must know your price function so you can derive total revenue. You must determine your price equation before you can calculate your total revenue. Now we have gotten the price function. Your total revenue. Total revenue is price multiplied by quantity. That is how you get your revenue. Quantity sold multiplied by. Now look at it. Our price is equal to A plus BQ. That means I can substitute, I can change P. I can do like this. New is equal to remove P. A plus BQ multiplied by Q. By substitution, I can also say my total revenue is equal to Q multiplied by AQ, Q multiplied by BQ, BQ squared. This is your total revenue. From this total revenue, we can derive our marginal revenue using differential calculus technique. From here, from this equation, you can get your marginal revenue. To maximize profits, marginal revenue must equal to marginal cost. Examiner can ask you to calculate selling price that maximizes profits. The examiner can ask you to calculate that selling price at which the company will maximize profits. Please don't forget, the selling price that maximizes profits is that price at a level of sales where marginal revenue equals marginal cost. Please don't forget, the selling price that maximizes profits is that price at a level of sales where your marginal revenue equals your marginal cost. This is what we call theoretical approach to pricing. It's also called economic approach to pricing. All right. We are done with all the explanation now. At least we are done with 80% of the principle. We can put question to it now. So go to your study kits. Somebody says it's not study park, it's study kits. Please go to page 76. Question number 6. Page 76, question 6. Can somebody confirm we are in that question now? Open your study pack on your system. We are starting with question number 6, page 76. Are we good to go? Amarachi, are you there?
Yes, sir.
Yes, we are there.
All right. So please, it's important to follow the question too. I'll read. Third Park, Nigerian Limited. Third Park, Nigerian Limited produces various types of packaging products. for food industry. The company has just introduced a new type of pack, and its marketing manager is considering how to penetrate the market with this pack. The following pricing strategies have been suggested. 1. Market skimming price. Market penetration price. Full cost plus price. Return on investment price. And marginal cost plus price. Next paragraph. The management accountant has provided the following data about the pack. 1. Non-current asset needed for the production of the pack, 2 million. Working capital requirements are estimated at 400,000. Expected annual sales volume, 40,000 units. Variable production costs are 60 naira per unit. Fixed production cost will be 300,000 naira each year. Annual non-production cost will be 100,000. The markup for the pack will be as follows. If full cost plus price is used, markup is 25%. If marginal cost plus price is used, markup is 40%. Target return on investment of 10% per year. Requirements. Requirements A. Discuss the above pricing method and advise when each could be used. Part A is for 10 marks. You are required to discuss the above pricing method and tell us when we can use each of these methods. Look at the method. Market skimming pricing. Who can explain this? You are going to tell us what is market skimming. When can company adopt market skimming for its products? Yes, from the students.
Okay, when they...
Who is speaking, please?
Market skimming is adopted when a company charges higher price when they newly launch in their products for the first time in the market.
All right.
So the company will use aggressive sales adverts to obtain a higher sales demand.
That is Oyindamola.
Yes, sir.
She said, market scheming, charging higher price. When a product is newly introduced, the company will use aggressive advertisements to obtain sales. I agree with you. Now the question is, when can we adopt market scheming? You have answered one part of the question.
When the product does not have a rival. If assuming the product is unique, there's no other product like it. So you can achieve, you can gain the market.
That's great. We can adopt market scheming when our product is unique in terms of quality and there's no rival product in the market. So Oyindamola has done justice to market scheming pricing. Number 2, you can mute Oyindamola.
Okay, sir.
Now, number 2 is market penetration. Yes, Amen. Let's hear you.
Yes, sir. Can we adopt this market scheming price when our product is in high demand?
Are you asking a question?
Yes, sir.
The question is, your product is even new. Amen, are you there? The question is,
yes. No,
that product
what
is
I'm
not
asking,
even known in the market. You are just introducing the product for the first time. So the question of high demand or low demand does not even come, because the product is coming to the market for the first time. We now want to determine the price at which we are going to launch our products. So the issue of high demand or low demand does not come to play here. So number 2, who is going to explain market penetration pricing? Yes, we are waiting. Who is going to explain market?
Yes. Hello, sir.
Yeah, Zoom
market
user.
Penetration is the opposite of market scheming, because it adopts charging lower prices when you introduce a new product into the market in order to increase your sales volume before a competitive product come into play.
All right. However, add that the Zoom user says market penetration is the opposite of market scheme. You are charging low price so as to obtain higher sales demand before competitors will introduce rival products. That's fine. The question is, when can we adopt market penetration?
When we want to increase the sales volume.
When we want to achieve higher sales volume. That's not correct. That is the objective of market penetration.
Okay, when a product is newly launched in the market.
When there is
When a-
rival product.
When the other
when there is rival
alternatives.
products. When a
We want
product
to
is
get
newly launched.
we
Who is
want to get
speaking
like a
now?
larger markets. It's on that. When you want to gain larger
Are you
share.
speaking to us?
Yes, sir. I want to say when the company wants that product to gain larger share of the market.
Okay. When can you adopt it successfully?
When, sir, market penetration can be achieved by a company when they are the cost leader in the industry.
Okay, Afolabi, let me hear you.
It can be adopted when there is a high competition in the market.
When there is high competition.
When there is strong competition in the market.
Strong competition, okay.
Yes.
The appropriate ways we can mute, we tried. You can raise down your hand, Folabi.
Okay.
Market penetration can be successfully adopted when the company is a cost leader. A cost leadership strategy. Market penetration can be adopted successfully if the company can produce at the lowest cost. That is the meaning of cost leader. For you to charge low price, you must be able to produce that product at a lower cost. You must know the right words to use. Yes, competition is high, but you cannot charge a low price if your production cost is high. Folabi, please bring down your hand. We can talk of market penetration. Company can adopt market penetration if that company is a cost leader. What is meaning of cost leader? The company can achieve production at the lowest cost, lowest possible cost. If you can produce at a low cost, then you can charge low selling price. If you charge low selling price, you can achieve higher sales volume. All right. Thank you all. Number 3. What is full cost plus pricing? When can we use full cost plus pricing to price a product? Please, if you want to speak, so as we have a decorum, you can signify by raising up your hand. Yes. What is full cost plus pricing? Oh yeah. Oh yeah, let's go.
Hello, sir. Can I say something? Full cost, full cost pricing is a situation whereby the company makes use of their their fixed and variable costs. Using their variable costs and their fixed costs to estimate their total cost of a product.
Okay. It's not complete, so.
And as you have said, they will have to add a certain percentage markup to the costs to get the total price of the products or the selling price of the product. Yes, sir.
Okay, that's good. That's good. Full cost plus pricing. A pricing method that considered both the variable cost and the fixed cost to estimate total cost. In addition to the total cost, certain percentage markup will be added to the total cost. Monsurat, Aremu, okay? Now tell us, when can we adopt full cost plus pricing? When can company adopt full cost plus pricing? Taking your total cost, both variable and fixed cost, then add certain percentage to it. Yes. Somebody said, we adopt full cost when they want to plan. That's it. Full cost plus pricing is used for planning. Company adopt full cost plus pricing for planning purposes. Number 4 method, return on investment pricing. So you are going to tell us, what is return on investment pricing? When can we use return on investment pricing for our products? Any Ọlọ́run dá? You want to speak to the group? Who is speaking to this?
Hello, sir.
Okay.
Yes, sir. Return on investment. Return on investments will be added to the total cost to get the selling price of the product. There's a percentage of return on. So that will be added to the total cost that has already been arrived at. That will not determine the selling price of the product.
All right. Let me hear from Joy. Where is Joy? I can see her hand up before. Is she gone? But when she comes back, for return on investment pricing, it's a pricing method whereby total cost of the product is estimated. In addition to the total cost, a target return on investment will be added to the total cost. a target or return on investment will be added to the total cost. We use this method Zoom user, you are wrong. Oh, this explanation is wrong. We use this method when the company wants to achieve a specific return on investment to meet a target investment return. So Zoom user, your explanation is wrong. Then the last one, marginal cost plus pricing. Oh yeah, who is speaking to this? Marginal cost plus pricing is when determine relevant cost.
It's when
Yes, Amarachi.
Low price. I think it's only the what they call it, the variable cost to be taken into consideration when they want to calculate the selling price. Variable cost of that of the item that you had.
All right, thank you, Amarachi. Although your line is breaking, but I overheard the fact that you said we are going to pick the variable cost of the product. Marginal cost plus is a pricing method whereby we consider only the variable cost. In addition to the variable cost, certain percentage markup will be added to the variable cost so as to arrive at the selling price. This method is used for decision making, short run decision making. Marginal cost plus method is used or is adopted if you are planning to make decision, short run decision. All right, thank you all. So please, why am I asking you to speak? Your exam, some question will be in theories. This question was texted ICAN 2019. So examiner can ask you theoretical question. All right, we are done with the 10 mark. Let's go to the B parts. Look at the B parts. Calculate what the price of the pack should be if its price is based on one, full cost. Calculate price of the pack using one, full cost plus price. That means if I want to use this method, I'm going to pick the variable cost as well as the fixed cost. Let's go to the data. Variable cost of production, 16 naira per unit. Variable production cost, 16 naira. We also go to pick the fixed cost. Fixed production cost per annum, 300,000. I'll pick that. Fixed production cost. This is units per unit, but this is 1 year. 300,000. I'll go again. Annual non-production cost. We are going to incur non-production cost also. Full cost, you must pick all the costs. Non-production cost, 100,000. We are talking about cost incurred to produce the products and to achieve sales. Non-production cost, that might be marketing cost, selling cost, total fees cost, total fees cost, 400,000. Total fees cost for this product is 400,000. But I want fees cost per unit because selling price will be calculated per unit. Now let's go and check. How many units are we going to produce and sell? Look at here. Expected annual sales volume. Volume of sales equals volume of production. Annual production volume is 40,000 units. I'll return here. Volume, production, 40,000 units, in brackets, units. I can get fixed cost per unit now. Total fixed cost divided by number of units. 400,000 divided by 40,000. Fixed cost per unit. 400,000 divided by 40,000 units. This is equal to 10 naira. Therefore, my full cost, variable cost per unit, 60 naira, plus fixed cost per unit, 10 naira. Your full cost is 70 naira. Full cost. It's also called your total cost, or you call it total cost per unit. 70 naira. You have gotten the full cost. In addition to the full cost, certain percentage markup will be added. Now, markup. Markup. What is the markup? Look at
25%.
it here. If full cost plus price is used, markup is 25%. Return here. 25% of 70. Please compute.
17 naira 50 kobo.
17.5. Now sum up. 87.5.
It's
That is the price per pack. If you choose to use full cost plus pricing, the price per pack is 87 naira 50 kobo. We move to number 2. Marginal cost plus price. How many questions?
Yes, sir.
Please go ahead.
Okay. Now, in the question given to us, there's an information regarding assets, cost of assets to be used to produce this pack. Now, assuming there's an information of depreciation, maybe depreciation will be let's say 25% per annum, something like that. Are we going to bring that depreciation into this full cost, into the total cost?
All right. Assuming there is depreciation.
Yes, sir.
There are 2 aspects to it. It's very possible that this annual non-production cost also include depreciation. It's also possible that it's not included. But if you are giving depreciation separately, you are going to bring it in. If you are dealing with full cost, is that better, please?
I'm good, sir.
But please don't bring in cost of assets. This is investment amount. If you look at full cost method, it's based on conventional accounting method. The absorption accounting system. Now, marginal cost plus. You only pick your variable cost, 60 naira per unit. In addition to variable cost, certain percentage markup. Examiner says if marginal cost plus price is used, your markup is 40%. You return here. Marginal cost plus price. Yes, Amarach.
I don't know if it's okay now. Can you hear me? Because I have a question. Is it okay now? Can you hear me, sir? I have a question I want
Yes.
to ask. Okay, we are talking about price here. We are talking about how to determine price or a selling price. So I want to really understand when we are talking about price. So the
Please, what is your
asset
question?
in which that's what I'm still getting there, sir. So the asset that we used to produce that
Your line is
Hello,
your
sir.
line is breaking.
Hello, sir. Can you hear me, sir?
Yeah, Frank.
Good evening, sir. Sir,
that
please, I want to
product
know the difference
is
between.
can't
Okay.
we how would I put it in determining the price? I don't know if you get
All
it.
right, Frank, hold on. Frank, hold on.
Okay, sir.
Amarachi, although your line is breaking, but let me draw your attention to something. Do not bring in your personal
So let me
view.
say this in. Let me say this in. Let me say this in.
Seems like she's having a network problem.
Now, let me quickly say something. The principle is established. If you are to calculate marginal cost plus, pick only your variable cost. Don't come and say, Shebi, we incur investment cost. Shebi, we incurred working capital cost. The rule is established. When it comes to marginal cost plus, pick your variable cost, then add certain percentage markup. When it comes to your full cost plus, pick your variable and fixed cost, then add certain percentage markup. Do not say, Shebi, we need to incur investment so we can produce. We need to invest the money first. We need to buy the assets first. You are bringing in your own principle, which is not in line with the principle of the topic. So that when she is watching the video, because the marking script is set, once you pick a variable not to be there, that thing is gone. There is a reason where we are going to use the investment. Yes, Frank, your question.
Thank you, sir. When you were solving for cost plus pricing, when you were I know that cost plus pricing is also markup cost price. And when you were calculating for markup, you did I don't know if I think what you expressed was a profit margin. I don't know if I'm wrong. I think it should be the cost plus the percentage. You should have added the 25% to the cost to give us the markup. I don't know if I'm wrong. Why the profit margin should be 25% of the cost. I don't know if we can visit that. Thank you,
You
sir.
know, this is what we did, Abi.
Yes, sir, please.
So what's wrong with this?
you know, I since it is markup that we're trying to calculate 25%, it should be 25% plus the yeah, I think yeah, I got it now. Thank you, sir.
Please compute 40% of your variable cost. 40% of 60 naira. This is 24.
25 naira. 24 naira.
24
now add
naira.
together.
That's 84 naira.
84 naira.
This is the price of the pack. Price per pack. If you are talking of marginal cost plus, the price per pack is 84 naira.
Correct.
We now go to the third one. Return on investment pricing. Look at this now. Return on investment pricing. This is where investment will apply now. So as much as possible, all calculations are driven by principles. All computations are driven by what? Underlying principles. It is that principles that will guide your computation. Return on investment pricing. What is the principle here? We are going to get total cost of the product. In addition to the total cost, we are going to add target return on investment to the total cost. What is the principle here? The principle says get the total cost of the product. Total cost per unit. We have calculated before. Total cost per unit or per pack. 70 naira. In addition to this total cost, then you are going to add target return on investment to it. Now, what is nice? Let's go to this. At target return on investment of 10% per annum. I will now calculate. First, how much are we going to invest in this project? Calculate total investment. Non-current assets. Investments. How much, please? Because of space. Non-current assets. We invested 2 million.
2 million.
Working capital requirements. We invested
400,000.
Non-current asset invested 2 million naira. Working capital investments or requirements required 400,000. total investment for this project. Total investment. $2,400,000. What is the target return on investment? What are we
10%.
target to achieve? Target return on investment. Examiner says 10%. Compute 10% of 2.4 million.
240,000.
That is what we plan to achieve. The target return, that is annual, annual target return on investment, 240,000. But I want target return per unit. Annual target return on investment is 240,000. But what I wanted is target return per unit. What's my volume of production or volume of sales?
40,000.
40,000 units. Calculate target return per unit.
6 naira.
Target return investment per unit. That will give me 6 naira.
6.
6 naira, sorry. 6 naira will be added to the total cost. 70. Come here. Selling price per unit. Price per pack. 76 naira. That is the target return on investment pricing. You are done with the question. You are done with your question. If you do summary, if you are looking at full cost plus price, the price will be 87 naira 50 kobo. If you are looking at marginal cost plus price, the price is 84 naira. If you are looking at return on investment pricing, the price is 76 naira. So please, as much as possible, the principle should stay with you. As much as possible, the principle should stay with us. All right. Sure, we can take one more question. This one. Let me look at this. Let's take question on This one in your book, Seth. I'm not sure it's in your book. Oh. Okay, we can even do this. Let's do pricing. Let's do theoretical pricing. Let me look at this. Let's look at this. John Nigeria Limited. I'm not sure it's in your pack. Oh. I think this question was tested maybe November diet, the first diet. I'm not sure it's in your pack. Or we can treat it. You can treat this question. After the class, I will share the question to you.
What year, sir?
I'm not sure it's there. Now let's look at this question. We have like 45 minutes more. Amarachi is not back. She had a very bad, the network is bad there.
Sir, what is the year of that question? Which diet was it?
Which one is that?
The one we want to treat now, John Nigeria Limited.
This, I think, is November diet. I'm not 100% sure. But let's look at the question. It doesn't matter the diet. What matters is the principle and the knowledge. All right, we go to it. John Nigeria Limited is launching a new innovative product into the market, and we need to decide on the right price for the products. The product's expected life is 3 years. Given the high level of cost which has been incurred in developing the product, John Nigeria Limited want to ensure that it set a price at the right level and has therefore consulted a market research company to help it do this. The research, which relates to similar but identical products launched by other companies, has revealed that at a price of 60 naira, annual demand will be expected to be 250,000 units. However, for every 2 naira increase in selling price, demand will be expected to fall by 2,000 units. And for every 2 naira decrease in selling price, demand will be expected to increase by 2,000 units. a forecast of the annual production cost which will be incurred by John in relation to the new product as follows. Annual production units from 200,000 to 350,000. Direct material price, direct material cost, direct labor cost, overhead cost. Requirement A. Calculate the total variable cost per unit and total fixed cost. Look at this question. If I'm to calculate the total variable cost per unit and total fixed cost per unit, what am I going to do? What am I giving in this question? When production is 200,000, I have material cost, labor cost, overhead. When production increase, cost also increase. When we increase also, if you look at this question here, this data, you have activity at the highest level. You have activity at the lowest level. You can adopt your high and low method. We need to test for cost behavior. Let me copy this to save me time. Let me copy this to save me time. Remember the knowledge of cost estimation. We want to know which of these costs is variable cost or fixed cost or mixed cost. I have direct material cost. I have direct labor cost. I have overhead cost. And I want to test behavior. The rule unit. Remember the rule when we treated cost estimation. Cost behavior. Total material cost 2.4 million. Annual production 200,000. Please get material cost per unit. Material cost. What do you have, please? 2.4 divided by 200.
12.
12 naira per unit. Again, check. 3 million divided by 250. 12 naira per unit. 12 again.
12.
What do you have here?
12.
12 naira. Remember the rule. If your cost per unit is constant, what kind of cost is that?
Variable cost.
Variable cost. As production volume increases, total material costs also increase. But material cost per unit is constant. I'll take that again. As production volume increases, total material cost also increase. But material cost per unit is constant at 12 naira. This is an indication that direct material cost is a variable cost. When you are done, go to your labor cost. Total labor cost 1.2 million. We produce 200,000. What is labor cost per unit? 6 naira. Next, 1.5.
Naira.
6 naira again.
Yes.
Check
6
again.
naira again.
6 naira again. Check again.
6 naira again.
Look at it again. As production volume increases, total labor costs also increase. But labor cost per unit is constant. This confirms that this labor cost is a variable cost. The principle will not change. Now overhead, let's test. 1.4 million divided by 200,000. What is overhead cost per unit?
7 naira.
7 naira, round, are we good? 1,550,000 divided by 250. What do we have here? 6.2.
6.2.
6.20. Check here. 1.7 divided by 300,000. What do we have?
5.67.
5.67.
67.
Check here. What do you have? 1,850,000 divided by 350,000. Oh.
5.29.
5.3.
5.3 approximately.
Okay,
Or
5.3 or 5.29, anyone.
29, yes.
Now look at this now. As your production volume increases, total overhead costs increase, but overhead cost per unit falls. What kind of cost is this?
Missed cost.
It's a missed cost. This overhead cost is a missed cost. It contains variable overhead and fixed overhead. What are we going to do now?
We will use high and low method.
Use high and low method.
Thank you. Put a note here. Overhead cost is a mixed cost. So we need to do high and low. High, low. Output, overhead cost. At the highest level, 350,000. Total overhead, 1,850,000. At the low level, 200,000 units. Total overhead, 1.4 million. The difference, 150,000 units. Difference in cost, what do we have?
450.
450. Get your variable overhead per unit. Variable overhead cost per unit.
3 naira.
Yeah.
We have to show the working man. 450 divided by 150. That is 3 naira. Now you have gotten your variable overhead cost per unit. Calculate total variable overhead, either at the highest level or the lowest level. At high level, total variable overhead is equal to, at high level, we are going to produce 350,000 units. Variable overhead per unit, 3 naira. What is total variable overhead?
1,050,000.
1,050,000. Return here. Look at it. What you are saying is total overhead here is 1,850,000. Out of this 1,850,000, 1,050,000 is variable. What is fees? Total fixed overhead is equal to 1,850,000 minus 1,050,000. What do we have?
800.
800,000. Requirement A says calculate variable cost per unit. My variable cost per unit is direct material cost, 12 naira. Direct labor cost, 6 naira. Variable overhead cost per unit, 3 naira. Totaling, sum up, 21 naira.
21.
This is my variable cost per unit. You are going to bring all the variable cost. Direct labor cost is a variable cost. Variable overhead is a variable cost. Remember, when we were doing this, the first topic, I said this topic can enter any topic. Our total fixed cost, total fixed overhead cost is 800,000. We have resolved requirements A. Calculate the total variable cost per unit and total fixed overhead. We have resolved requirements A. Requirement B. Calculate the optimum selling price for the new products and calculate the resulting profit for this period. Price is equal to A minus BX. The marginal revenue is equal to this. Examiner kept this question simple for you. The examiner has even given you marginal revenue. This question was kept simple. I'll try and get it right. I think it was recent question set. Now let's go to it. First, what is optimum selling price? Your optimum selling price is that selling price that maximizes your profits. Your optimum selling price is that selling price that will give you the highest profits. For me to get optimal selling price, I'm going to equate marginal revenue to marginal cost. The optimal selling price is that selling price at which the level of sales, that price at a level of sales where marginal revenue equals marginal cost. Please, you must try to get the principle. Now let's go to this. Let me bring this closer. Let me bring this requirement closer. Oh, excuse me, please. All right. So your starting points. Examiner says P. P is A minus BX. Or you, at time you use Q. That means it has introduced minus automatically. Remember we said this. We can use the approach we are giving ourselves. We are going to get the same answer. Your P is equal to A plus BQ, where P is the current selling price. Go back to the question. Examiner says, at a price of 60 naira, annual demand will be 250. So at a price of 60 naira, our P is 60. Your A, price at which demand is 0. We don't know yet. We have to calculate that. Your B, negative change in price over change in quantity. Examiner says, back to the question. For every 2 naira increase in selling price, demand will fall by 2,000 units. Change in price 2, change in quantity 2,000. For every 2 naira change, demand will change by 2,000 units. Return here. My B is equal to minus 2 over 2,000. Please work this out. What do we have? Negative 0. What?
Hello, sir. Please, that A, you said A is equals to price at which demand is what?
0.
0.
Okay, okay.
What do you have when you divide? What do you have? What do you have here? That should be how many self? I'm trying to get my calculator.
Minus 0.001.
0.001, yeah. That will now change now. Your Q, or you can call it S. Your Q, quantity. Examiner says at a price of 60 naira, annual demand will be expected to be 250,000 units. This is 250,000 units. You have to get your price equation first. Your P is equal to A plus BQ. Our P is 60. Our A is unknown. Plus bracket our B minus 0.001. Multiply by our Q, 250,000. Open the brackets. $60 is equal to A plus times minus 250. I hope I'm correct.
Yes, sir.
What is your A? A is equal to 60 plus 250. That is 310. You have gotten your A. You can now return back. Our P is equal to A 310 plus bracket my B 0 point negative 0.001. Then our Q. When we say price function, you must get equation. P is equal to 310 minus 0.001 Q. This is the price equation. This is the equation that you are going to use to derive your selling price. Please note, at a selling price of 60 naira, that is not the optimum selling price. That 60 naira is not the price that will maximize profits. You have gotten your price equation. Price is a function of autonomous price minus the gradient multiplied by the quantity. Examiner has given you the margin. Examiner says, remember, we said to maximize price, to maximize profits. Let's expand this. So is that price at a level of sales where marginal revenue equals marginal cost. The optimum selling price is that selling price at a level of sales where the marginal revenue equals marginal cost. Let me put this here. Optimum selling price is the price at a level of sales where marginal where the marginal revenue equals to the marginal cost. What this means is that you have to equate the two. Examiner says marginal revenue is equal to A plus BS 2BX. Your S is your Q. I'll return here. Marginal revenue A minus 2BQ. My marginal cost. Your marginal cost is your variable cost. We have calculated variable cost per unit, 21 naira. Equate the two. A what happened? I can imagine this. That the team even refused to share. Let's continue. Your marginal revenue A minus 2BQ is equal to 21. Our A, we have calculated before, self. Please remove this. Our A is what? 310. Why am I doing this? Our B is what?
Our B is minus 0.01.
310. The sign here, they have imparted that B, that minus. So this is equal to 2 brackets 0.001. Q is equal to 21. That minus has been taken care of because it's supposed to be plus before, it has changed. 310, open the bracket, minus 0.002Q is equal to 21. What is Q? I will collect light terms. 0.002Q is equal to 21 minus 310. (21 minus 310), what do you have? This is minus here. Minus 0.02Q. What do we do there? We collect light terms. There's Q here. There's no Q here. I'll move 310 to the back. It becomes minus 310.
Minus 289.
Minus 289. Negative 0.002Q is equal to negative 289. Negative cancel negative. What is Q, please?
144,500.
I'm coming. I need to put it. Okay, it's moving on my hand. I see. Let me expand this more. I got to expand this more. This is enough. I will now do like this. Q is equal to 289 divided by 0.002. What do you call it, please? One was
144,500.
144,500 units.
500.
That is the level of sales that we maximize profits. That is the quantity of sales that we maximize profits. Now, once you have gotten your queue, now go to your price function. Price is equal to 310 minus 0.001 Q. The price equation. Price is equal to 310 minus 0.001 Q. Now, if Q is 144,500, what is price? P is equal to 310 minus 0.01 multiplied by 144,500. Please work this out.
$89. Oh, sorry.
What do you call it?
Hold on.
Here we give me P, 310
144.5.
minus 144.5.
4.5.
What is your P?
P is
165.5.
165.5. That is the selling price that we maximize profit. Your optimum selling price is 165 naira 50 kobo. That is the selling price at which we are going to get highest profit. Examiner says, calculate optimum selling price for the new products and calculate the resulting profits. We can get profits. We can get the resulting profits. I need to go down small for me to get this profit. Your profit is revenue less cost. One more. Oh, one more. Okay, let me see. I'll come here. Optimum selling price. The optimum selling price 165.5. Variable cost per unit 21 naira. Please get contribution per unit. Contribution per unit 165.5 minus 21.
144.5.
144.5. Quantity sold. The quantity that will maximize sales. Quantity. That is the optimum quantity. Remember, we have 144,500 units. Is that not?
Yes.
Now get total contribution. 144,500 multiplied by 144.5.
20,880,250.
Thank you, ma. Let me show it here. Total contribution. Let me show it here. 144,500 multiplied by 144.5. 20 million.
880.
880.
250.
Five what?
250.
250.
0.
You have gotten total contribution. What next? Less your total fixed overhead. Total fixed overhead cost. We calculated this to be how much? 800,000. Have you forgotten?
800,000.
That was our calculation in one. Therefore, your profits. What is the profit? 20 million.
0.
250.
250. You are done with requirement B. For this question, examiners help you to calculate your marginal revenue. You have calculated your marginal cost. Some question, examiner will not help you to calculate marginal revenue. You calculate yourself. Requirement C is theory, so no issue. Requirement C. The sales director is unconvinced that the sales price calculated in B above is the right one to charge on the initial launch of the product. He believes that a high price should be charged at launch so that those customers who are prepared to pay higher price for the product can be skimmed off first. Discuss the conditions which will make price skimming a more suitable pricing strategy for John Limited. Recommend whether John Limited should adopt this approach instead. What are the conditions that will make market price skimming suitable? Please, when you get back, look at that solution. We are still going to take one more question on this. Look at the theoretical, this question we solved. I said it's kept simple. We are going to take one more question on this. So go through it. What are the conditions that can make price scheming successful or suitable?
When the product is unique.
When the product is unique and there is no rival.
There's no rival, yes.
Now, this product, is it unique? We don't even know. Market scheming. As the sales director suggests, market scheming is a strategy which initially charge high prices for the new products. They have to take advantage of those buyers who want to pay, who want to buy it as soon as possible and are prepared to pay high prices. They have to do so. If certain conditions exist, this strategy can be adopted, could be suitable for John. What are these conditions? When a product is new and different, so that customers are prepared to pay high prices, they have to gain the passive status of owning the product early. Point number 2, where product has a short life cycle, the strategy is more likely to be used. Because of the need to recover development costs and make profits quickly, John Limited Products has a 3-year life cycle, which is fairly short. Where high prices in the early stage of the product life cycle are expected to generate high initial cash inflow. We can also use market scheming where there is barrier to entry exists, where competitors are deterred from entering the market. You can use price scheming. Where competitors are prevented from producing similar products, then you can do market scheming. According to the information given, high development cost was involved in this scheme, which could be a barrier to entry. To develop this product, company incurred higher development costs. This can prevent other companies from doing similar products. All right. We are done with the question and it's closing time. Please, I'm very much aware that you might struggle with it at the initial point. But I'm very sure that if you sit back and look at the step we have taken, it should get better. Any question? Clarification? All right. I will be checking out of the classroom. May God give us a better understanding